S&P 500 futures are oscillating right at the flat line this Tuesday morning, May 12th, 2026. The implied open is dead neutral.
Yeah, completely paralyzed.
Right. I mean, we're hovering pre-market with the ES parked around 5,850. It's just a tight sideways grind between yesterday's momentum and the absolute mammoth overnight catalyst dropping in just a few minutes.
Exactly.
So your mission for this deep dive is to decode exactly what's moving the tape today. We're going through a huge stack of institutional notes to identify the specific data triggers and, map the technical lines in the sand so you don't get chopped up.
Because today is absolutely not a standard trading day.
Not at all.
The entire session basically hinges on the 8:30 a.m. Eastern CPI print. I mean, that is the single point of failure for the market today.
And consensus is sitting aggressively at 0.6% month over month.
Right, and if that prints accurately, we're looking at year-over-year headline inflation getting pushed to 3.7%.
Which is a massive hurdle.
It's a potential 3-year high hitting the wire right before the opening bell. And, you have to understand the mechanics of how this gets digested.
It's not humans reading it.
Exactly, no. When that 8.30 data drops, it's thousands of algorithmic trading bots programmed to parse that specific 3.7% expectation. They're executing block trades in milliseconds based purely on the deviation.
And we're approaching this print during an incredibly precarious Fed transition. I mean, this week is Jerome Powell's final act.
Yeah, handing the keys over.
Right. He officially hands the Fed chair seat to Kevin Warsh this Friday. So the exact numbers we get this morning completely define the policy floor for the incoming administration.
They really do. And if you look at Warsh's historical stance, the market has been actively pricing in hopes for this dovish Warsh pivot on day one.
But Powell's basically deciding this morning if he's smoothly passing the baton or handing over the yoke of an airliner that's mid-stall.
Yeah, the hidden vulnerability here is that a hot print completely incinerates the market's hope for that pivot. If inflation comes in at 3.7% or higher, Warsh doesn't get to step in and cut rates to appease equity markets. He has to immediately move to crisis management just to maintain credibility.
And you really can't objectively look at that 3.7% expectation without factoring in the massive supply-side shock happening in global energy right now.
No, you can't. It's the elephant in the room.
Let's unpack the geopolitical inputs driving that, just strictly through the lens of market mechanics. President Trump is in Beijing meeting with Xi Jinping while simultaneously rejecting the latest Iranian peace proposal.
Right.
And the immediate quantifiable impact of that rejection is that the Iran ceasefire is on massive life support.
Which instantly reignites the supply-side risk premiums in the Strait of Hormuz. I mean, that corridor is arguably the most critical energy choke point on the planet.
Yeah, maritime insurance premiums for tankers are skyrocketing.
And the overnight session priced this in immediately. Brent crude surged past $107 a barrel.
Wow, 107.
Yeah, that specific oil spike is the ghost haunting this morning's CPI numbers. At $107, energy costs mechanically bleed into every single layer of the supply chain.
We're talking soaring bunker fuel costs for global freight.
Exactly. Higher petrochemical input costs for manufacturing and just immediate margin compression for logistics companies.
So the macro pressure cooker is fully set. We have the CPI cliff at 8:30, but the moment we survive that print, you have to navigate the secondary effect, which is the bond market's reaction.
The bond market is ruthlessly pricing this in.
Right now, yields are putting an absolute vice grip on technology stocks. Looking at the overnight data, the 10-year yield spiked 6 basis points to a massive 4.68%.
It's huge.
And at the exact same time, the dollar index, the DXY, is firming up at 105.20.
Yeah, and that specific macroeconomic combo creates what institutional desks call the double squeeze on big tech.
Break down the math on that squeeze.
Okay, so when you have a 10-year yield pushing aggressively toward 4.75%, you're mechanically altering the discounted cash flow models for every major corporation.
Because growth companies derive their valuations from projected cash flows way out in the future.
Exactly, 5 or 10 years out. When the risk-free rate hits 4.68%, the denominator in that equation swells. It violently shrinks the present value of those future earnings.
Which makes current NASDAQ multiples look kind of indefensible.
Completely indefensible. Capital demands a much higher premium to take on equity risk when they can get nearly 5% risk-free.
And then you factor the firming DXY at 105.2 into that same equation.
Right. The strong dollar actively incinerates the international profit margins of the Magnificent Seven.
I mean, if a U.S. tech giant sells a cloud subscription in Europe, they collect euros. When the DXY is this elevated, those euros buy significantly fewer dollars when they're repatriated.
That's the textbook double squeeze. Higher bond yields compress the valuation multiple, and a strong currency physically compresses the actual revenue.
So momentum in the broader tech sector is stalling out.
Yeah, institutional capital is actively scanning the tape for a reason to rotate.
Wait, I have to push back here on behalf of the listener, right? Because retail has been universally rewarded for buying the NASDAQ dip for the last 10 years straight.
Yeah.
Every single time institutions called a top and said multiples were too rich, retail won by aggressively buying the gap and go. Why shouldn't a trader just load up on tech calls right now?
Because that is the ultimate retail blind spot. It feeds directly into what institutional desks call the pain trade.
The pain trade.
Yeah, retail traders mistakenly assume that a yield spike crashes every sector equally. It absolutely does not.
A 4.68% yield actually signals robust nominal economic growth, right?
Exactly. And institutional money understands this divergence perfectly. The true pain trade right now isn't some violent 2008-style crash where everything goes to zero.
The actual pain is bleeding out on tech valuation compression while entirely missing the violent rotation into the old economy.
You nailed it. While retail sits around patiently waiting for a tech dip that mathematically never feels cheap enough to buy, the smart money is moving massive amounts of capital.
They're rotating into cyclical stocks, the S&P Equal Weight Index, energy.
Yes, domestic industrials that actually benefit from a stronger U.S. dollar. Traditional value companies that can handle higher financing costs are grinding higher.
So the retail trader gets left behind holding speculative tech bags.
While under-owned value stocks become the new market leaders.
But if you look at the pre-market volume right now, there's one glaring exception to this tech double squeeze.
Oh, the memory supercycle?
Exactly. It's the only subsector keeping the NASDAQ breathing. Capital is fleeing speculative sauce names and seeking immediate refuge in hard tech and AI infrastructure.
Because AI infrastructure demand is just vastly outstripping global supply chain capabilities. We are seeing unprecedented record margins in high-bandwidth memory HBM.
And building those fab plants takes years.
Years, yeah. So the companies holding the supply right now have total pricing power. This semi-strength is basically the market's only functioning shield against a broader tech sell-off this morning.
So let's look at the pre-market movers to see how this plays out. Top of the board is Micron Technology, ticker MU. They're up 6.5% pre-market.
Huge move.
They're the direct beneficiary of this AI DRAM shortage. But here's where macro geopolitics cross streams with tech. Micron CEO, Sanjay Mehrotra, is actually in Beijing right now, sitting with the Trump Xi delegation.
Right, which signals Micron's manufacturing footprint is way more than just a hardware play. It's a critical geopolitical chess piece in these trade negotiations.
So what are the strategic levels for MU today?
The bull case line in the sand is a definitive break above $800. If it clears and holds $800 on high volume, that confirms the supercycle leg up.
And the target there?
The next major institutional resistance target sits way up at $867.
But the asymmetrical downside risk is anchored entirely to that 8.30 CPI print, right? If we get a hot inflation number and yields spike further, what's the floor?
The critical downside level is $740. If MU fails to hold the $780 pivot after a hot CPI, algorithmic selling will trigger a rapid retreat back to that $740 support.
Compare that aggressive movement to NVIDIA, ticker NVDA, which is trading completely sideways right now.
Yeah, caught in a massive tug-of-war.
You have fundamental AI demand acting as the bull catalyst, but the stock is simultaneously fighting the valuation drag of that 107.7 oil we talked about.
And speaking of that oil drag, ExxonMobil ticker XOM is up 1.2% in the pre-market.
Directly capitalizing on the Strait of Hormuz supply-side risk premium.
Exactly. We're also closely tracking on holding, ticker ON. Very volatile this morning after a Q1 drop.
Yeah, and the institutional focus there isn't just on the shoe brand itself, it's squarely on the broader consumer.
Right, the core thesis being debated is whether consumer discretionary spending is finally starting to buckle under the weight of these sticky energy costs.
Now, if you want to see exactly where the retail pain trade is actually materializing on the tape, look at AST Space Mobile, ticker ASTS.
Oof, yeah, down 13% following a catastrophic Q1 earnings miss.
They posted a loss of $0.66 per share against the $1.23 loss expected. And it isn't just a basic earnings miss. You have to look at the mechanics of their cash burn runaway.
Right, combine that huge EPS miss with deep institutional skepticism over the ongoing delays in their Bluebird 7 satellite rollout.
A delayed satellite means burning massive amounts of operating capital without generating projected revenue.
And in a 4.68% yield environment, financing that shortfall with new debt is prohibitively expensive.
So retail is heavily long and trapped on ASTS right now.
Very trapped. The technical levels here are a matter of survival. ASTS needs to reclaim the $64.20 psychological floor instantly just to stop the bleeding.
But the absolute line in the sand
Is $56.50. That is the 2026 technical low. If it breaches $56.50, we're going to see a brutal liquidity flush.
Unpack the mechanics of that liquidity flush for the listener. How does that actually play out on the order book?
So market makers can see exactly where retail traders have parked their stop-loss orders. If ASTS drops past that 56.50 floor, retail accounts will trigger automated margin calls.
Broker is just indiscriminately liquidating positions at market price.
Exactly, to cover the margin debt. This creates a cascading waterfall of sell orders. Institutional desks just sit slightly lower on the bid, scoop up those shares at an artificial discount, and then the price eventually stabilizes.
Man, let's pivot to the complete opposite end of the spectrum. We have a pure turnaround play going parabolic. BuzzFeed, ticker BZFD, is up roughly 150% in the overnight session.
Yeah, wild.
Media mogul Byron Allen agreed to take a $120 million majority stake and step into the CEO role.
And at this exact moment, this is a pure arbitrage play. Byron Allen's stake inherently pins the valuation to his acquisition price.
So the bull case level is exactly $3.
Right. The market will naturally gravitate aggressively toward that deal ceiling. Any significant spread below that price is effectively free money for institutional arbitrageurs, assuming the deal closes.
But the exposure there is pure execution risk.
Totally.
If this deal faces regulatory friction or financing hiccups, the bear case is a violent gap filled right back down to the fundamental consensus floor of $1.
So look at the stark contrast across these pre-market tickers. Micron is flying on hard infrastructure demand, ASTS is collapsing under speculative delays, and Exxon is climbing on macro oil dynamics.
Let's update that cafeteria analogy. The lunch money in this market is physically shrinking because of the DXY and high yields.
Yep.
The smart institutional money is abandoning the flashy speculative sauce tables entirely. They're moving exclusively to the tables that grow their own food, the heavy-duty infrastructure kids, and the old-school energy crowd.
That's exactly what's happened.
So with all these violently conflicting signals, AI booming, sauce suffocating, oil surging, the 8.30 CPI cliff, how do you actually approach the open today?
By recognizing the exact environment you're operating in. Today is absolutely not a breakout day. We are sitting in a massive liquidity trap.
Market sentiment is strictly neutral.
Right. Large cap breadth is stalling, and volatility is heavily compressed. This creates a prime, highly lucrative environment for stop hunting.
Detail the mechanics of that trap.
Market makers are going to intentionally probe extreme technical levels this morning to trick breakout buyers. They want you to see a false break of resistance on a 1-minute chart and aggressively chase the momentum.
And the exact moment retail commits that capital.
The institutions fade the extreme. They intentionally flush the price right back into the middle of the trading range to grab sell-side liquidity.
So the defining strategy is to fade the extremes. Do not chase the initial move in the first 30 minutes.
Let the market show its hand.
All right, let's get into the specific data density. These are the exact lines in the sand you need marked on your screens before the bell rings. Starting with the S&P 500 futures, the ES. The pivot point this morning is 5,850.
We're watching a fierce tug-of-war on the ES between defensive value rotation and active profit-taking and growth. For the S&P, the line in the sand for resistance is 5,875. That is the hard ceiling.
And the timing associated with that level is critical. Institutional notes are clear. Failure to hold above 5,875 by 10:30 a.m. Eastern signals a confirmed fake-out.
Right, if it can't hold by 10.3, it inevitably returns to the mean.
What about downside risk?
Support line in the sand is 5,820. Heavy institutional buy orders are parked right there on the ledger. But if 5,820 snaps, we drop to 5,785 incredibly fast to fill the technical gap.
And if we look at the broader S&P index itself, it's coiling extremely tight at 7,400.
Yeah, if that 8.30 CPI print is cool, the broader index runs straight to 70,500. If it's hot, 7,300 is the only structural support that matters.
Trade the data print, not your prediction of the print.
Exactly.
Let's move to the NASDAQ futures, the NQ. The pivot is right at 20,400.
Semis are slightly cooling off in the aggregate, and that 4.68% yield is putting a hard mathematical cap on aggressive multiple expansion for the NASDAQ.
The resistance line in the sand is 20,550, but the hidden trap here is getting chopped up by a quick wick on the chart. You can't just blindly buy the first tick that crosses 20,550.
No, 20,550 is a massive, high-volume supply zone. Institutional sellers are parked there in heavy force. You need to see a sustained 15-minute candle physically close above that level to confirm any genuine upside bias.
And looking downward on the NQ, the absolute must-hold support for the bulls is 20,250.
If 20,250 fails, the whole narrative shifts instantly. We go from calmly talking about a healthy consolidation straight into a widespread correction.
Targeting psychological support way down at 20,080.
The absolute bottom line for surviving a liquidity trap is respecting these precise boundaries. 5,875 and 5,820 on the ES, 20,550 and 20,250 on the NQ.
If the market is aimlessly chopping around inside those levels,
The house wins. Your capital decays to theta. You have to sit on your hands and wait for a definitive reclaim of resistance or a structural breakdown of support.
So, synthesizing everything we've unpacked today, this session is fundamentally an exercise in intense patience.
Very much so.
It's about respecting the algorithmic chaos of the 8:30 a.m. CPI cliff, the compounding implications it holds for Kevin Warsh taking over the Fed, and recognizing this quiet, somewhat violent rotation of capital out of highly valued growth and into the old economy.
And above all, refusing to be lured into the early morning stop hunting traps. The incoming data dictates the action.
Right.
The market is actively pricing in the harsh reality of $107 oil and 4.68% yields. You have to adapt your strategy to the exact environment the market is providing you today, not the bullish environment you might hope for.
Which brings us right back to Powell handing Warsh the controls of a stalling airliner. If you ignore the macro data and blindly buy the tech dip today just because it worked in 2024, you're walking straight into the propellers. So if you're finalizing your levels and waiting for that opening bell, I want to leave you with this final thought. If this pain trade rotation, this massive shift of institutional capital from tech growth into old school value industrials and energy, if this mathematically becomes the new normal for the rest of the year, how much of the last decade's entire investing playbook is about to become completely obsolete? What if the safe technology stocks of yesterday are quietly becoming the absolute riskiest assets in your portfolio tomorrow? Stay sharp out there today, let the market show its hand, and watch the clock.